Welcome, everyone. I'm Brian Hartstein. I head up the 401k here at Bayntree, and we're dedicated to helping all of our participants with the 401k plans that we advise in all facets of the 401k plan and financial planning. And it's hard to believe we're already at the end of 2019 and into the fourth quarter. So we're going to kick off our year-end planning and setting financial goals 401k educational webinar. And we're real excited to share the information that we have to help you kind of finish up your year-end planning and then get started with your goals and setting the right plan and the right course for 2020. So again, my name is Brian Hartstein. I head up the 401k team here at Bayntree. And with me today is also Chris Roger and John Gengle. They're part of our team. They're advisors that are here on staff. And again, part of what we do is help participants, whether it's with assessing the risk tolerance, helping them set their right investments inside their account and optimize their account, helping with financial planning related questions, and how your 401k integrates into the planning that you've done and the planning that you might do in the future. And we've also got Rena Blanco and Jessamaya who round out the team. And again, we're dedicated here to helping you. There's no cost for any participant or employee of the 401k plans that we advise to access us and utilize our tools, our technology, and our knowledge and service to help you in any way possible. So we always urge you, if you have questions, if you need help, please feel free to reach out via phone, via email. We're local in Scottsdale. We have offices across the valley, so if you are local, we can meet with you. But if not, please feel free to contact us in the manner that you wish so that we can help you with your plan. So today we're going to look at cleaning up some of our planning for 2019. We're going to look at increasing or maxing out your 401k plan's contributions if possible, looking at limits, reviewing health insurance and health savings accounts, as well as flexible spending balances. We know that not all companies offer those, but we do work with companies that do offer those, so we want to make sure that people have the right knowledge and the right information. Looking at risk and beneficiary reviews, and then we're going to start looking at our 2020 planning about developing a holistic plan, improving your retirement readiness, and setting the right goals for 2020 and beyond to get you where you want to go. So real quick, let's review 2019 and 2020 contribution limits for 401k plans and also for IRAs. So for this year, if you're under age 50, the maximum amount that you can defer out of your own pay is $19,000 for the year. That does not include any employer match that you may receive. If you're over age 50, there is a catch-up provision which lets you put an additional $6,000 away in out of your own pay. So again, if you're under age 50, the limit's $19,000 for 2019. If you're over age 50, it's $25,000. In 2020, the IRS has indexed those limits up so that if you're under age 50, it's $19,500, and you have a catch-up provision for those over age 50 of $6,500, so that your maximum over age 50 is $26,000. So again, 2020, it goes up to $19,500 for under age 50, and over age 50, it's at $26,000. And for those of you that are eligible and do qualify for either a traditional or Roth IRA contribution, the combined limit for 2019 is $6,000, and there's a $1,000 catch-up limit for those over age 50 of $1,000. So again, if you're under age 50 for the traditional or IRA or Roth IRA, it's $6,000. If you're over, it's $7,000, and that will not change for 2020. It's going to be the same number. But again, some people don't know whether they qualify or not, and again, we here can help. So if you think you might qualify or you may want to put monies in a traditional or a Roth IRA and you're already participating in a 401k, give us a call here and we can help you determine whether you're eligible or not.
Okay, hi everybody, my name's Chris Roger. As Brian said, I'm one of the financial advisors here. So Brian just went through the contribution limits for 401ks and IRAs for 2019 and looking out towards 2020. So we get a lot of questions on, well, how much should I be adding to the 401k? And a good rule of thumb is try to put in enough to get the full match. So if your company offers a 3 or 4% match and you're putting in 2% of your pay, you're not getting the full match that the company's offering. So let's say, for example, your company's offering a 4% match. So you want to at least try to put in the full 4%. from your own pay. So you're putting in your 4%, the company's putting in their 4%, now 8% of your salary is going into the 401k. If you can afford to put in more, usually we encourage individuals to do so. So a good rule of thumb, if you can put in more than the match, you want to try to put in 10% of your gross income. So if you're making $50,000 a year, you want to put in $5,000 into some sort of retirement plan, 401k plan. And with the year coming to a close and looking out towards 2020, some of you may be getting an annual raise. And with that being said, we get some questions sometimes on, well, what should we do with our additional raise? So let's say you're getting a 3% raise. Maybe you bump up your 401k contributions from 4% to 5%. So now you're getting 2% more back in your pocket, 1% more you're paying for yourself, or maybe you want to put all of the raise into your 401k because you have budgeted things accordingly and you don't need the additional income. So you could save it later for retirement. So there's no one-size-fits-all approach for that. Obviously, we encourage clients to participate as much as they can in the 401k plans. If you max them out for the year, you can look at either IRA, Roth IRA, but you got to be careful with there's certain income thresholds you may be over, so you just want to understand those thresholds, and that's what we're here for, to help make life a little easier for you guys. So we get a lot of questions too on, well, what should I do with my old company's 401k, or maybe you have multiple former 401ks, and not everybody's right move is perfect for everyone. So maybe it makes sense for some people to take their 401ks and move it to their current 401k plan, and other people may be in a different stage, and it might make sense for them to roll it into an IRA plan instead of a 401k plan. So it just really depends. There's no one-size-fits-all approach, but when it comes to planning, we find that most people like to keep it simple, keeps things easy, and the more simple it is, the less room for error. So when you consolidate your 401k, if you have a current 401k plan that you're contributing to, most 401k plans allow for what's called a rollover from another 401k plan. So you can roll money from your old company plan to your new company plan. And if you have questions on, well, how does that work? And do I get taxed on that? If you do it correctly, you won't get any taxes. So that's, again, what we're here for. Please feel free to use us as a resource to help make sure that you don't do anything that you might regret tax-wise. And again, there might be some reasons for individuals to have multiple accounts. Maybe they're close to retirement and they have an IRA that they're handling themselves, or they have a team handling it for them, and maybe that's a little bit lower risk. And then with the 401k, maybe you want to take a little bit more risk there because you're adding money to it. Again, not perfect for everybody. Everybody's situation is a little bit different, but if you have questions on what you want to do, feel free to use us as a resource. So another type of account that you can contribute to for retirement, there's two types of accounts here. There's a health savings account and a flexible savings account. They're a little bit different. Both will be used for medical expenses. So a health savings account, if you're under age 55 as an individual, you can see here you can add up to $3,500. Over age 55, you could do $4,500. And then as a family, they're doubled. So you can do $7,000 for a family under age 55, and you get the extra $1,000 increase. So you get up to $8,000 for age 55 and over. But we're encouraging individuals, if they can, to add to a health savings account. And what a health savings account is, it's an account that you can add money to, and any money you add to a health savings account, you get a deduction on, just like with your 401k. So if you add $3,500 into your HSA account, you get a tax deduction on that. So you're not taxed on the money on the way in, and actually inside of the HSA account, you can invest that money. So the drawback is there's not a vast amount of options that you can actually invest in with the HSA. So the selections are relatively limited, but you can invest it. So if you put $3,500 in there and later on it grows to $4,000, you don't pay tax on the $500 gain that accrued inside the HSA account. Now, later on, if something comes up and you have a medical expense, maybe an ER trip, you broke a bone, something like that, you can take money out of your health savings account, and there's no tax consequences for you to do so if you use it for qualified medical expenses. So think about the power of that. You can put money in, grows tax deferred, and then you can take it out tax-free. So for that, it gets the triple triple whammy for the tax benefit. You get the tax deduction, tax deferral, and tax-free on the way out. So no other retirement account does that for you. So if you can, we always encourage individuals to take advantage of the HSA. The Health Flexible Spending Account, it's a little bit different. You could put up to $2,700 into that plan, and the reason why the FSA isn't as possible, money goes into it from your paycheck. You don't pay taxes on the money that goes into your flexible spending account, but the drawback is if you don't spend all the money by the end of the year, it's gone. So if you put $2,700 in there and you had a healthy year and you don't use it, it's gone. You don't get to pull it back out and take it and move it somewhere else. So, they're not as popular as the HSA, and if we were to encourage someone to pick between the two, we'd pick the health savings account compared to the FSA. But again, there's a lot more to it than just what we covered here. So if you have additional questions, definitely just let us know.
All right, Jonathan Gengle here, again, one of the financial advisors that you can tag if you have any questions or concerns in regards to your personal planning. I'm going to quickly go through a risk review, which touches on asset allocation. So how actually an individual might want to invest their assets, whether they're in an IRA or a 401k or some other type of investment account. So we have kind of this general pyramid here that takes into account a low to a high risk asset allocation. Now, I'm sure everybody's heard about having diversification, and it is important among these different asset classes to have some exposure to each. Now, again, in general, if an individual is younger and has just started working, they are going to be able to afford to take a higher amount of risk, so that middle and top tier in terms of investment options. As they get closer to their retirement, they're going to want to look at shifting to that low risk base. Those are going to be secure. You have to understand that there is going to be a trade-off between risk and reward. But again, these are just kind of rules of thumb, and in general, and individuals may be different as well. You may have a young person that is very risk averse for whatever reason that may be. So it's important to kind of evaluate your own situation, and that's where we can come in and ask you some important questions and kind of try and determine where you are in terms of risk scale and how do we mitigate and eliminate certain risks within the asset allocation. Now, housekeeping item here that's fairly important and everybody should check on an annual basis is updating their beneficiaries. So you want to make sure if you've moved employers, moved plans, that the beneficiaries are listed as you want. Now, if you're in Arizona or California, they're both community property states, so primary beneficiary is going to be the spouse unless your spouse is willing to sign off and you want to appoint somebody else. But beyond that primary beneficiary, it's important to have some contingents listed. That means those are individuals or an individual that you would list in case the primary beneficiary is incapacitated or has passed away prior to receiving those funds as the beneficiary. So it would be split between any of those contingent beneficiaries. So just make sure, it won't take very long, just go in and check and make sure you have those individuals listed that you want in those different roles as beneficiaries. Now, lastly, really important kind of closing on setting goals for 2020. We want to make sure that you really have a comprehensive plan. So a 401k is going to provide a fairly large component of an overall retirement plan, but it's important that you understand how that fits into your overall fiscal house. So make sure you've created a budget. Figure out what your inflows and outflows are. Make sure that you have short-term, intermediate, and long-term savings to offset any potential future financial risks, but also seek future opportunities so you can benefit from contributing and planning of all these years. So we really encourage people to build a plan. If you don't know where to start, give us a call, send us an email, and we can give you some good pointers to get you rolling.
Awesome. Well, hopefully you found this of value. John and Chris and I and the rest of the team, again, we bring a lot of expertise and knowledge here to the table, and it's all at your disposal so that we can hopefully help you and your family get where you want to go, achieve your financial goals, and take advantage of all of the opportunities that you have available to you. So again, We're here via phone, via email. We do Zoom calls on the computer, and we also can meet live. So again, we hope you reach out to us. We're looking forward to speaking with everybody. We hope you have a wonderful and happy holiday season and a prosperous and healthy 2020. Thanks again, everyone.